bum, 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 bum. Well, hello. We're going to have a chat about oscillators. And a warm welcome to one and all. For those of you not seen me before, my name is Langers, and I am the coffee obsessed Scruffy trader that requires a coffee. Timed that just well. Well done. Good girl. See that? Whoosh. What a girl. She is a girl and all. So, it's not what we're here for. What these series of videos are little sound bites to make a foundation about trading. And what I'll do is I'll do kind of little bits, and they're all driven by you guys out there. If you ask me the question, I will put it into a foundation. Now, some of them are public, some of them are for the Scruffy squad. If you're interested in seeing trading in real terms, please check that out, because you'll see it real time and very transparent, as with some of the videos you've recently seen where I show my statements. I genuinely put my money where my mouth is. So what are we going to do? Well, let me flip the screens over and we'll have a chat. Now, oscillators are basically a bounded indicator. And what that means is they'll have a higher bind and a lower bind, and it'll oscillate between the 2 points. So it can't break the top and it can't break the bottom. So in terms of looking at a chart, they are good because they can show you when a market is extremely stretched. In other words, when it's pushing. But it also shows you when the market is in high acceleration and volatility. And I've left this screen on simply because it highlights it quite well. Now, with most indicators, the higher you go up the time frames, the stronger they become, because there's more information driving them. They're all built on this massive equation of higher lows and price coming back on itself and pushing forward. It's very complicated, but you don't really need to know that. You just need to know what to look out for. So at the moment I have an RSI on here, and what it's illustrating, if I take off this center point and stretch it up a little bit so you can see it. An RSI standard setting is 14. You'll often find 14 is the standard setting for most indicators. Oh, great stuff. Thank you. What a girl. You can come again. 14 is the standard setting for most indicators. It's just kind of a universal. Now, the RSI is deemed to be overbought when it gets above 70 and oversold when it gets below 30. Now, does that mean there's going to be a reversal in the market? Not necessarily. But what it's telling you is whatever's going to happen, there is going to be a reaction at this point. So case in point, if you were looking at traditional values, when this goes into deep red here, the market should reverse. However, it didn't. It flattened out. So in this instance, what it's telling you is the level, the strong level, is holding the price back. However, the oscillator is still staying in the red. In other words, it is overbought and primed for reversal. So what you're seeing now is a bunch of reds coming into the market, but they are not strong enough to force the market down. So in this instance, what this is doing is it's letting you know that the level is strong. Okay, it's a key level. And for, let's say, from Tuesday right the way through to Wednesday, that level held. Okay, so it's a combination of the two. It's the level and the RSI. Now, when it bursts through eventually, here, you can see the RSI is telling you it is time to drop. When it shot up, if I widen this out slightly, there it is there, and it burst through, it went up to another level, but then sold off. Okay, and then it's meandered its way back down into a chop, and now it's pushing up yet again. Okay, so that's one way to look at it, just to read the chart. Now, oscillators are not necessarily triggers to get you in and out of the market, although you can use it that way. What they're very good for is telling you the condition of the market. In this instance, as I was saying, it was telling you that this level was going to hold. Okay, now if we go further back in time, sort of here, there is the cross at this point. So again, this is a level that I put in and worked the zone out. Look how far the market went back up. Okay, so at this instance, what you would be saying, if you were entering the market at this point and you've got a strong level above it, and this is in the red, we know price gravitates to levels. If you get your levels right, and that is one of the key things that you need to do, and if you ever speak to any of the guys in the Scruffy squad, they will tell you I spend a lot of time getting my levels right. And if you get the levels right, the rest of it is easy, you know, because they are the real roadmap of the chart. And that's what you need to do, because X does not mark the spot. You know, you need to work out whether the market is moving up. Well, in this instance, it is. It's crossed the RSI, telling me, right, there's going to be a reaction. So where's the next level? Well, it's up here. So if I'm looking to trade, I'd be looking to get out around this area based on this RSI, because I know it's going to push up, which it did. It's tagged the level, and the level is held for quite a while before it bursts through. So that's one way to look at it. The levels are incredibly important. So the next part, what you can look at is, say, a stochastic. That is one of the next bigger oscillators. Now, there is quite a few, but they all work the same way. They're all bounded. Now, in this instance, it's above 80 and below 20 for your overbought, oversold conditions. Now, there are two sort of settings for this. This is a fast stochastic on a 533. And as you can see, it's caught that move perfectly on here. It's ramped up. And again, it's the same situation. That level has held. And when it came away, see, it's come all the way down there, but that hasn't moved that far. But if you had an overall bias to the upside, because that's the other part of trading, you need your levels in place and you have a bias in place. And what you're doing is you're waiting for the indicators to align themselves to, well, basically how you've read the market on the morning. And again, there we are. It's come back to reset. So if you have a feeling that this is going to go to the upside, well, you can start getting back in, but be very wary of this level. It bursts through here. And again, if I marry that up, there we go. If we marry that up, it catches the drop, which is back into chop. Okay. Now, the other setting for this is a 14.33. And what this does is it smooths it out a little bit. And if we just crunch that up slightly, again, you can see the levels are in play here. So the price has come down. We know there's going to be a reaction. There's your reaction, and it's caught that move. There is the move to the downside, which it's caught again. Comes all the way down. And what you're doing is you're following it. Very, very simple. Now you can use this to get in. You can use it to get out. But you're better off using it to see the condition of the chart and use your levels and your candle patterns, etc., to then get in. All right. So it was a quick just overview of what an oscillator is and how you could basically use it. Now, through the week, I'll add more into this, and I will put it to the test on Friday, because you can speed these up, you can slow them down depending on what you're looking for. And you'll often find that you'll see traders, like take your stochastic here, instead of having it on a 14, they might well put it on a 21 or a 28 just to smooth it out. But then you could go the other way and be aggressive and speed it down to a 10, or as you saw with this stochastic, which was a fast stochastic to start with, a 5. So again, it's kind of your own preference, your own personal. But what I will say is, once you've found settings that work for you, don't fiddle with them. Leave them. Because then you're not reading the same conditions over and over. If you like a 21 RSI, leave it on a 21 RSI. If you like a 14 RSI, leave it on a 14 RSI. You know, and you can have it in two ways. You could even have two settings. You could have a very slow setting to get an overall feel of the market, and then just use a faster one as a trigger. It's another way of trading, guys. Just something for you to think about. So I'm going to enjoy the coffee. If you've got any questions, by all means, contact me. All my details are in the description below. There are free links if you want to see some of the software that's there, and also discounts off prop firms. And if you're looking for a good broker, check out Black Bull. It does have 500 to 1 leverage at this moment in time, and it'll stretch your pennies out. And both of the links will give you access to free education. So hope that helps, because just trying to add a little bit of value for you guys. So as always, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.